Today, we're going to analyze the relationship between ExxonMobil stock price and WTI crude oil commodity price. ExxonMobil is the largest oil company in the US and is traded on the New York Stock Exchange. As a major producer of oil, I believe that Exxon's stock price should be affected by the price of crude oil commodity price. The main question in this video is whether we can create a statistical arbitrage trading strategy that involves trading a stock against a commodity. Trading a stock is easy. But how can we create exposure on crude oil? Instead of buying physical barrels, we have two options. You can either trade WTI futures on the New York Mercantile Exchange, or you can trade WTI ETFs, such as the United States Oil Fund or USO. USO is an exchange trade fund that tries to track the price of the underlying commodity. Because futures contracts have a monthly expiry date, for simplicity reasons, we will be analyzing the relationship between Exxon's stock and USO ETF. First, let's start by importing historical data on both assets. On the left side, you can see the price chart of Exxon, and on the right side, you can see the price of USO for the past 2 years. Let's plot the price on the same chart and see if we can find any relation between the two assets. The blue line represents the price of Exxon, and the red line represents the price of USO. Upon visual inspection, you can see that the two assets show some correlation. Now the question is whether there is a linear relationship between Exxon and USO. In other words, can we construct the price of Exxon using USO price times some ratio? In this linear regression simulation, you can see the two asset prices on the left side. At each point, we then measure the price of Exxon and USO. On the right chart, we then plot this data sample with Exxon being the x-axis and USO being on the y-axis. If you look at the dots, you will find that we can find the relationship between the two assets. When the price of Exxon rises, so does the price of USO. If we draw a linear regression line, the relationship becomes evident. Let's now get back to our formula. The ratio we are looking for is the slope of our regression line. In the example between Exxon and USO, the ratio is 1.5. In other words, for every $1 that Exxon moves up, we expect USO to move up $1.5. This is our Exxon versus USO chart. Let's see what happens if we multiply the current USO price with the ratio 1.5. On this new chart with the USO adjusted price, we see that the prices are now nicely overlaid. If we subtract Exxon price minus the USO adjusted price, we can compute the spread between the two assets. The spread is the difference between Exxon price and USO price multiplied by the ratio. Buying the spread represents buying Exxon and selling USO at the same time. Selling the spread represents selling Exxon and buying USO at the same time. Now that we have calculated the spread, let's try to create a mean reversion strategy. For a mean reversion strategy, we want to trade a spread that is stationary. By looking at the chart, we see that the spread does oscillate around 0 and that most of the values are contained between minus 10 and 10. If you bought the spread at minus 10 and sold the spread at 10, these would have been amazing trading opportunities. Now, let's try to create and backtest a trading strategy. But before we can do that, we want to check whether the spread is mean reverting or, in other words, stationary. By running the ADF test on the time series, the results suggest that Exxon and USO are co-integrated. Let's now run a backtest simulation using Bollinger Bands. A Bollinger Band is a technical indicator used for mean reversion trading. It consists of a simple moving average and bands that are a certain number of standard deviations away from the simple moving average. In this backtest, we are using hourly timeframe data and a Bollinger period of 200 with 1.75 standard deviations. Whenever the price crosses the lower band, that is our signal to buy, and when price crosses the upper band, that is our signal to sell. We then exit the positions at the simple moving average. In the backtest, we are trading with a starting balance of $10,000. The position size is 100 stocks of Exxon against 150 stocks of USO ETF, which is based on the ratio that we have computed. In total, we have generated a backtested P&L result of plus $2,508. On this chart, you can see all the trades in the backtest visualized on the spread chart. As you can see in the P&L result, the strategy is not risk-free as it also generated some significant drawdown. but overall it is nice to see a positive outcome. This analysis was made with Python and Jupyter Notebook. If you want to learn more about how we research and backtest trading strategies, you can visit our website atjresearch.com. At ATJ Research, we offer algorithmic trading education, you can access trading courses in Python, and we publish articles on various strategies and backtests. Thank you and see you in the next video.